Welcome everyone. Today we're diving into a crucial topic, investing in your 20s. This decade of your life is a golden opportunity to set the stage for a secure financial future. The power of compound interest is on your side, and time is your greatest ally. The benefits of starting your investment journey in your 20s are vast and long-term, setting you up for a comfortable retirement and beyond. Investing early is not just a good idea, it's a game changer. So, let's get started with our top 10 tips. Tip number 1. Understand your financial goals. This is where it all begins, folks. Investing is not just about making money, it's about achieving your financial aspirations, whatever they may be. Buying a house, starting a business, or even something as simple as taking a dream vacation. These are what we call short-term goals. Then we have long-term goals. Perhaps you're thinking about a comfortable retirement, sending your kids to college, or leaving a legacy. These are goals that will take more than 5 years to achieve. Your financial goals are like the North Star in your investment journey. They guide your decisions, helping you choose which investment opportunities to seize and which ones to pass up. They help you determine how much risk you're willing to take and what kind of investor you want to be. Knowing your financial goals is the first step towards successful investment. So let's get to know them, shall we? Tip number 2, start saving for retirement now. You might think, retirement? But I'm just starting my career. And that's exactly the point. The earlier you begin, the more time your money has to grow. This is all thanks to the magic of compound interest. So, what is compound interest? Imagine a snowball rolling down a hill. As it rolls, it picks up more and more snow, growing larger and faster. That's essentially how compound interest works. Your savings, or the snowball, grows not only from the money you put in, but also from the interest it earns. And the best part? The longer the snowball rolls, or the longer your money is invested, the bigger it gets. So even if you can only afford to save a little each month, start now. It will pay off in the long run. The sooner you start saving for retirement, the better. Tip number 3, diversification is key. Let's unpack this. Imagine a juggler. The more balls they have in the air, the less likely it is that dropping one will end their show. That's diversification in a nutshell. In the world of investments, diversification means spreading your money across a variety of asset classes, such as stocks, bonds, and real estate. Why do this? Well, each of these asset classes behaves differently under the same economic conditions. When one goes down, another might go up, balancing out the overall impact on your portfolio. Think of it as a safety net, cushioning you against unexpected market downturns. It's important to remember that diversification doesn't guarantee profits or protect against all losses, but it does help manage risk. And here's a saying you might have heard before: don't put all your eggs in one basket. It's a simple reminder that diversification is a key strategy in managing your investment risk, so keep those eggs spread out. Tip number 4, invest in what you know. Now this may seem like a no-brainer, but you'd be surprised how many people overlook this simple principle. When you invest in sectors or companies you understand, you're not just throwing your money into the wind and hoping for the best. You're making an informed decision, which can significantly reduce your risk. Imagine for a moment that you're a tech enthusiast. You're familiar with the latest gadgets, you know which companies are at the forefront of innovation, and you understand the industry's trends. Wouldn't it make sense to invest in that space? You'd be able to better predict the direction of the market, identify potential opportunities, and avoid pitfalls. Investing is not about blindly following trends or tips from so-called experts. It's about leveraging your knowledge and understanding to make intelligent decisions. Remember, in the world of investing, knowledge is power. Tip number 5, make regular investments. It's like setting a steady pace in a marathon. You don't have to sprint at the beginning only to run out of energy halfway through. Instead, you can invest a small amount consistently, whether it's weekly, monthly, or quarterly. That's the beauty of the strategy called dollar cost averaging. It means you're buying more shares when prices are low and fewer when they're high. Over time, this can lower the average cost per share of your investments. It's a simple, time-tested strategy. Plus, it's easier on your wallet than trying to time the market with large, infrequent investments. Regular investing can also help smooth out the ups and downs of the market. You'll be less likely to panic when prices drop and more likely to stay the course. Remember, investing is not a sprint, it's a marathon. Consistency is key in investing. Tip number 6, avoid emotional decisions. Now this one might seem a bit tricky because, after all, we're all human. Emotions are part of our DNA. But when it comes to investing, allowing your feelings to guide your choices can lead to some pretty risky business. Fear and greed. These are the two big emotional culprits that often lead investors astray. Fear can make us sell low when we should be holding on, and greed can make us buy high when we should be cautious. So, how do you keep your emotions in check? The answer lies in doing your homework. Research, strategize, and stick to your plan. Don't let a sudden market dip or surge sway your decision-making. Remember, investing is more of a marathon than a sprint. It requires patience, perseverance, and a level-headed approach. Stay calm, cool, and collected in your investing. Tip number 7, be patient. Now this might seem like an odd one. You may be thinking, I'm investing, I want to see returns now. But here's the thing, investing is not about instant gratification. It's a long-term game. You're planting seeds today for a harvest in the future. So, you need to be patient. You've heard of the phrase, slow and steady wins the race, right? That's exactly how it works in the world of investing. It's not about making a quick buck, but about growing your wealth over time. And remember, the stock market has its ups and downs. It's important to stay the course and not get swayed by short-term fluctuations. So don't get disheartened if you don't see immediate returns on your investments. Keep calm, carry on, and let your money work in the background. Remember, investing is a marathon, not a sprint. Tip number 8, keep learning. The world of investing is dynamic, always in motion, always evolving. Just like a shark, you've got to keep moving or you'll sink. The most successful investors are those who stay curious, who commit to lifelong learning. Why? Because the market is a complex beast, fueled by global events, technological advancements, and shifts in consumer behavior. To navigate this ever-changing landscape, you need to keep your knowledge fresh and up to date. So, how do you do it? Read financial news, follow market trends, learn about new investment strategies, attend webinars, listen to podcasts, take online courses. Be curious about what's happening in the world around you and how it could impact your investments. Remember, knowledge is power, and in the world of investing, it's also profit. So, embrace the journey, stay hungry for knowledge, and never stop learning. Investing is a journey of continuous learning. Tip number 9, review your portfolio regularly. Just as you wouldn't set a ship to sail and never check its course, you shouldn't ignore your investments after you've made them. Regularly reviewing your portfolio allows you to adjust and realign with your financial goals. Whether the market is up or down, it's important to keep a keen eye on your investments. This way you can make necessary adjustments and ensure your financial ship is still on course. Regular reviews keep your investments on track. And finally, tip number 10, seek professional advice. No matter how much research you do, there's a lot to be said for the expertise of a financial advisor. They can provide personalized advice, tailored to your unique financial situation and goals. What's more, they can help navigate complex financial markets and potentially save you from costly mistakes. Remember, even seasoned investors turn to professionals for guidance. A little professional guidance can go a long way. Well, that's it. We really appreciate you taking the time to watch these gems for success. In a nutshell, we've explored the importance of understanding financial goals, starting retirement savings early, diversifying investments, and the value of patience. Remember, investing in your 20s is a powerful move for your financial future. But before you go, please like this video and share it with your friends on social media. If you're new here, don't forget to subscribe so you won't miss out on other engaging videos like this one. Thank you for your support.